The Federal Reserve announced Wednesday it will begin purchasing $40 billion in Treasury bills per month starting December 12th, a larger than expected move aimed at maintaining sufficient liquidity in financial markets as the central bank seeks to retain control over its interest rate target framework. The decision, which came alongside a quarter percentage point interest rate cut to a range of 3.5% to 3.75%, caught markets off guard. Investors had anticipated purchases would start in early 2026 at a scale of $15 billion to $20 billion per month, not the $40 billion figure announced for immediate implementation. The committee judges that reserve balances have declined to ample levels and will initiate purchases of shorter-term Treasury securities as needed to maintain an ample supply of reserves on an ongoing basis, the Fed stated in its policy announcement. Reserve pressures prompt action. The purchases represent a reversal from the Fed's quantitative tightening program, which ended December 1st after shrinking the central bank's balance sheet from $9 trillion to $6.6 trillion since 2022. During that period, the Fed allowed Treasury and mortgage bonds to mature without replacement, drawing liquidity from the financial system to help combat pandemic-era inflation. Recent volatility in overnight funding markets signaled reserves had tightened sufficiently. In late October, banks tapped the Fed's standing repo facility for a record $50 billion in a single day amid month-end liquidity pressures. The federal funds rate also began trending higher within its target range, prompting officials to halt balance sheet reduction. New York Fed President John Williams said in November that determining when reserves reach adequate levels is an inexact science. Roberto Perli, who oversees policy implementation at the New York Fed, indicated at the time that given what we know today, we probably won't have to wait long before expanded buying begins. Market implications. According to the Fed's operational statement, the initial $40 billion in purchases will occur over the next 30 days, with the buying pace expected to remain elevated for several months before being significantly reduced. The purchases will focus on Treasury bills with maturities of 1 year or less. Bank of America had predicted ahead of the announcement that the Fed would launch purchases at a $45 billion monthly pace starting in January. The bank's forecasts stood out for both its timing and scale, with strategist Mark Cabana arguing that markets were underestimating the extent of the Fed's balance sheet actions. The reserve management purchases differ from the quantitative easing programs deployed during the 2008 financial crisis and COVID-19 pandemic, as they aim to maintain liquidity rather than provide economic stimulus. However, the injection of cash into the financial system could still provide support to asset prices as the year concludes.